Hello everyone, welcome to Mastery. It's Rosario's Academy. Here in this video, we're going to discuss about the income tax paid adjustments, how it should be treated on final accounts. As far as sole proprietorship is concerned, according to the Indian Income Tax Act 1961, business and ownership is not separated. It is clubbed into one. His business income is treated as a personal income, so that the income tax paid is not the business expenditure, rather it is shown as a drawing to the owner, because he is taking some money as a drawings and he is paying the income tax. So that is how it should be treated. So that the treatment would be, adjustment entry would be drawings account debtor to bank account. Same as when you are taking the money as a drawings, what would be the journal entry? That is what the same entry should be followed here as an adjustment entry. Drawings account debtor to bank account. Obviously, the drawings account should be shown on the liability side by deducting it from the capital. In one of our previous videos, I could remember I have given the structure capital less net loss or add net profit, add interest on capital, less drawings, less interest on drawings, and finally less income tax paid. Even we can add this income tax paid with the drawings because both are drawings only, but in order to show it separately, we are subtracting after subtracting the drawings. So the structure, normal structure would be, once again I just want to repeat, capital, add interest on capital, add net profit or less net loss, less drawings, less interest on drawings, and finally less income tax paid. So the balance sheet treatment is going to be on liability side. It should be subtracted after subtracting the drawings. It should be subtracted from the capital. Okay, less income tax paid. So the balance value should be written at the outer column. So this is what the adjusted capital. So after subtracting drawings, after subtracting income tax, after adding net profit, or after subtracting the net loss, this is what the final adjusted capital at the end of the financial year. Isn't it? Okay, when it comes to, since it reduces the bank balance, we have to reduce it from the bank account. Bank account, put it in the inner column, less income tax. Income tax paid. So subtract and put the balance value at the outer column at the asset side. So that is how we should treat the income tax paid. It should be subtracted from the bank account and also it should be subtracted from the capital. As far as the adjustment entry is concerned, it's well known. Drawings account debtor to bank account or cash account. So this is how we should treat the so the narration would be income tax paid. Income tax paid. So that is how we should treat the income tax account. As far as sole proprietorship is concerned, business and ownership is not separated. The business income is treated as his personal income. So with this view, the income tax is treated on the balance sheet or on the final accounts. One more thing is, there is no treatment on the trading or profit and loss account. We have to show it only on the balance sheet, both the sides, by subtracting from the bank account on the asset side, and in the same way by subtracting it from the capital account after subtracting the drawings, because this is also considered as one of the drawings, but in order to show it separately after subtracting the drawings, the income tax value is subtracted from the capital. Thank you so much for watching.